Digital advertising is a multi-hundred-billion-dollar industry. But how does the money actually flow? In this module, we're going to follow the money, from the advertiser who wants to reach an audience, to the publisher who gets paid for that audience's attention. And we'll explain the three main pricing models that govern every digital ad transaction. Ad revenue is the economic engine of the internet. An advertiser sets a budget, say $100,000 for a quarter, and wants to use it to reach their target audience online. That budget flows through a DSP or ad network, which takes a platform fee, often 10 to 20%. The remainder goes into the ad auction through an ad exchange. The exchange takes another small percentage, typically 5 to 15%. The winning amount flows through the publisher's SSP, which takes its own fee, and finally reaches the publisher. Publishers monetize their content through advertising by offering their ad inventory, the spaces on their pages and in their apps, to advertisers. The three main ways this inventory is priced are CPM, CPC, and CPA. Each represents a different economic model with different risk profiles for both sides. CPM is the oldest pricing model in digital advertising, inherited from traditional media. TV, print, radio all use cost per thousand measures. It's still the dominant model for brand awareness campaigns. CPM stands for cost per mil being the Latin word for thousand. It represents the cost an advertiser pays for every 1,000 ad impressions. If your CPM is $20, you pay $20 for every 1,000 times your ad is displayed. CPM is best suited for brand awareness campaigns where your goal is to maximize reach and visibility. The main limitation of CPM: it doesn't measure whether anyone was actually engaged. CPC is the dominant model for search advertising. Google Ads built its empire on it. The key insight is that CPC aligns advertiser costs with user intent. You're only paying when someone shows interest by clicking. The formula: CPC equals total ad spend divided by number of clicks. If you spend $1,000 and receive 500 clicks, your CPC is $2 per click. CPC works best when your goal is driving qualified traffic to your website. The advantages are clear. You only pay when someone engages. But CPC has real limitations. The most significant is click fraud, illegitimate clicks generated by bots or by competitors trying to drain your budget. Competition is the biggest factor. In highly competitive categories like insurance, finance, or legal, CPCs can be extraordinarily high. CPA is the advertiser's dream model. You only pay when something valuable happens. But publishers and platforms often resist pure CPA because they bear all the risk. Many platforms offer target CPA, bidding where you set a goal CPA and the algorithm optimizes toward it. The formula: CPA equals total ad spend divided by number of conversions. Spend $1,000, get 100 conversions. CPA equals $10 per conversion. CPA is ideal when you're running direct response campaigns, e-commerce, app installs, lead generation, and you can accurately track and measure conversions. Lowest financial risk. You only pay for results. Direct measurement of ROI. A closely related metric is ROAS, return on ad spend. ROAS equals revenue divided by ad spend. A ROAS of 4 means $4 of revenue for every $1 spent on advertising. Harder to set up than CPM or CPC. You're paying a premium for the result, not just the opportunity. In practice, campaigns often use multiple pricing models across different stages of the funnel. Awareness at the top with CPM, consideration in the middle with CPC, conversion at the bottom with CPA. This full funnel approach aligns cost structure with campaign objectives. That wraps up Module 6. Let's quickly recap what we covered. How ad revenue works: CPM, cost per mil CPC, cost per click CPA, cost per action, choosing the right pricing model,